The government, presented in pink, is acting as a foundation to claim ownership of the bottom-up economy. The private sector, Cyan, is pinned against the 100% line. As the pink area ratchets up, the cyan area doesn't just get smaller, it looks like it's being suffocated against a hard limit. The cost of capital boundary is the gold line sitting exactly on the border between the two, to show you the friction generated by the government crowding into private space.
They told you fiscal policy is a safety net for the bad times. They were lying. Today we will show you why, then tell you how you should process and react. After today's incident response, you will transition from being passive observers to active analytical responders.
The macroeconomic engine is currently running on a dangerous fuel of perpetual debt. As of early 2026, the global debt load has surged to a staggering $348 trillion, with nearly $10 trillion added in just the last year. It is crucial you understand that this isn't just a number, it is a fundamental shift in how your world is being financed. I am talking about the fiscal policy trap, where they spend your future to buy today's silence. No one should be fooled by the emergency labels they slap on every spending bill. Isn't it suspicious how fiscal policy is supposed to be countercyclical? The mechanic is clear. They should save during booms and spend during busts. Instead, look at the recent news of ballooning deficits during periods of supposed growth. Mathematically, when the government runs massive deficits, they compete with private borrowers for capital. This crowding out effect isn't a theory. It's a structural parasite on real investment. They claim it's stimulus, but it actually forces interest rates higher or compels the central bank to print more. It's a convenience scam for politicians who want to stay in power without ever balancing a checkbook. They aren't building a future, they are auctioning it off to the highest bidder while you pay the interest. Look at the bottom of the graph. That pink area is government debt. It's the base layer of our capital pool. Notice what happens when a recession hits. The pink floor rises to rescue the economy. But look at what happens when the boom returns. The floor doesn't drop. It stays exactly where it peaked. Now look at the cyan area pinned against the top. That's private investment. Your ability to start a business or buy a home. Every time the government ratchets the floor up, it crushes the private sector against the ceiling. The space for your future is physically disappearing. That gold line between the two, that's the cost of capital. It's the friction caused by the government bidding against you for the same finite pool of money. As the pink floor rises, the gold line follows, making it more expensive for you to survive just so the government can fund today's political silence. When the auction of growth tag appears, the story is over. The private sector is now just a thin sliver at the top of the chart. The government has occupied the territory of the future. They didn't build a new economy, they just crowded you out of the one you had. I want to revisit and continue to build our mental map about the global synchronization of monetary policy. When the world's major central banks move in unison, the individual saver loses the ability to find a safe harbor. The scam is visible in how closely interest rates now move together compared to the past. This is known as the correlation of central bank policies. During the 2021-2023 inflation spike, over 90% of global central banks raised rates simultaneously. This was the first time in history that almost every nation caught a cold at the exact same moment. The IFE suggests that if the US has a 5% rate and Japan has 0%, the yen should appreciate by 5% to balance it out. The reality is, in a crisis, flight to safety overrides math. Everyone buys the reserve currency, the dollar, regardless of the rate differential. As a result, emerging markets and smaller economies get crushed. They are forced to hike rates, even if their local economy is dying, just to stop their currency from vanishing. The sneezing that causes linkage is the statistics describing how US monetary policy exports volatility. When the Fed merely suggested it might stop printing money in 2013, capital fled emerging markets so fast that countries like India and Indonesia saw their currencies drop 15 to 20% in weeks. Not to mention, at the peak of the digital vault era in 2020, over $18 trillion of global debt carried a negative yield. Because markets were linked, Japanese and European negative rates acted as an anchor that pulled U.S. long-term yields down, regardless of U.S. domestic needs. The conclusion we should draw here is the global linkage ensures that savers cannot escape via diversification. If every major bank is devaluing the currency or suppressing rates at the same time, there is no exit button in the traditional fiat system. Look at the beginning of the timeline. A rainbow of sovereign choices. The different start values create a beautiful, chaotic spread. It visually respects the history of the 1980s where nations actually had different destinies. The UK, Japan, the US, all dancing to their own tune. This was the era of independent math. Correlation was low and your savings had a place to hide. However, this is also the hallmark of the illusion of choice. Watch as the timeline progresses. Notice how the linkage starts to tighten. The lines aren't just moving together. They are being magnetized to the blue lead. The noise is being sucked out of the system. This is the death of sovereign policy. You can think of this as the magnetic pull. And there it is, the sneeze. Do you see when the blue line spikes, the red flash hits, the other lines start to vibrate and overshoot? The lead nation hikes, and because the linkage is now at 95%, the rest of the world catches a violent fever. The international Fisher effect says this should be a smooth adjustment, but look at the lines. That vibration is capital flight. That is the sound of your savings account catching a cold, because a central bank 5,000 miles away decided to pivot. By the end, the rainbow is gone. There is only one cable, one direction, one misery. The scam is complete. Globalization didn't give you more options. It just ensured that when the ship goes down, no one is allowed to leave the deck. Look at the trend growth lie where they redefine success while the economy stagnates. No one should swallow the propaganda that a 2% growth target is healthy when it's mathematically built on sand. Isn't it convenient how they ignore the output gap to hide their failures? The mechanic is clear. Long-term growth is supposed to come from labor supply and productivity. But instead of real productivity, we get financialization. They've created a system where the neutral rate is constantly manipulated to justify keeping the engines running hot. Mathematically, they are just pulling tomorrow's consumption into today, leaving a hollowed-out shell for the next generation. It's a convenient scam to avoid the structural changes. They're too cowardly to implement. They tell you the economy is growing, but isn't it true that your cost of living is rising faster than your paycheck? They aren't managing growth. They are managing a slow-motion collapse. Look at the thick white line. This is the official 2% growth target, the North Star of every modern central bank. It's smooth, steady, and relentless. They call this success. But this line isn't a measurement of productivity. It's a target for financialization. Now look at the pink dashed line. That is structural reality, actual productivity and labor supply. Mathematically, it's flatlining. The debt-funded gap, you see hatched in pink, is the hollowed shell. This is the space where real work was replaced by cheap credit to keep the numbers looking healthy while the foundation rotted. By the end of the graph, the gap is massive. They tell you the economy is growing, but the quality of life collapse is the only real metric that matters. They aren't managing an expansion. They are managing a slow-motion bankruptcy of the next generation. That white flash is the moment of failure. From that point forward, you are living in the strangulation zone. You aren't growing, you are being liquidated. Now let's expose the politicized central bank and the total death of independence. No one should buy the neutrality myth they sell during press conferences. Isn't it obvious that when government debt is high relative to GDP, the central bank becomes a hostage question? The mechanic is a brutal feedback loop. Rising deficits coerce banks into keeping policy accommodative to inflate away the real value of the debt. Mathematically, this isn't a solution, it's an inflationary spiral. Higher inflation leads to higher nominal rates, which leads to faster debt accumulation, which calls for even more printing. It's a convenient scam where they sacrifice your purchasing power to save the government from its own insolvency. They claim they are independent, But isn't it funny how the yield curve steepens the moment the market smells this coercion? They aren't protecting the currency, they are liquidating it. Look at the early phase of the graph. The central bank, Cyan, is chasing inflation pink 1-to-1. They tell you they are data dependent and independent. Your purchasing power white is stable. But look at the background, the dark gray mass. That is the debt-to-GDP ratio. It is a silent growing weight that is lowering the fiscal ceiling every single day. Notice the cyan line policy rate hits the white dashed line ceiling and is forced to snap horizontally. The white dot flashes right there, the event horizon. The central bank hits the math of the debt. If they hike one more time, they bankrupt the treasury. In an instant, independence dies. The Fed is now a hostage. Notice how the cyan line is forced to flatline even as inflation pink continues to rocket upward. They are no longer fighting for you, they are fighting for the state's survival. But look at the gold line. That's the market. It smells the capture. Even if the Fed holds the short-term rate down, the market pushes long-term yields up because it knows the currency is being liquidated. This gap, this liquidation zone, is where your savings go to die. Every dollar of that space is a direct transfer of wealth from your pocket to the government's balance sheet. By the end, the heist is complete. The central bank isn't protecting the dollar, they are auctioning it off to keep the lights on in the capital. They aren't managing the currency, they are managing its funeral. Here is what I want you to do given all of these no BS angles. Stop ignoring the fact that crowding out is a silent tax on your prosperity. I want you to see that when a government runs massive deficits, loose fiscal policy, it must borrow from the same pool of savings you use. It's time to admit that this creates a crowding out effect where government demand for capital pushes real interest rates higher, making it more expensive for you to buy a home or start a business. You need to wake up to the reality that central bank independence is a convenient illusion. I need you to see the logic of central bank coercion. When government debt to GDP ratios become extreme, the central bank is often forced to keep policy accommodative to prevent the government from going bust. This leads to a politicized central bank, where the priority shifts from fighting inflation to managing the state's interest payments. You have to realize that once you see terms like output gap, trend growth, and structural changes for what they really are, levers used to justify these interventions, you can no longer be a passive victim of the convenience scam. Finance is interesting, but only if you realize that the system is currently designed to harvest your future to pay for their past.
Always keep in mind that finance is interesting because it is a series of deliberate trade-offs. The scam is simply when those trade-offs are hidden behind emergency labels and complex math. Remember, always look past the technical jargon to recognize the structural realities of the current economic environment.
This concludes today's incident response. See you in the next crisis.